Hello guys, glad to have you on board again today. Instead of just stating all over the same old shit each and every week, don't do anything with the cryptos, just be patient. Don't do anything with the stock market, don't just be patient. Because that's basically the only same old stuff I've got to say today. Wall Street is just trying to grind itself upward once again without actual real economical news follow through. It's just hopes and dreams, and we're going to pay for this as long as it works out. But we've got early signs of volatility reactivation last week. The yen is back under support area. The junk bond sector is falling. So we've got problems, definitely, but once again, not priced in by the stock market. So it's hard to say day after day, you must remain a seller even though that market is rising. I know how hard this is, but this is exactly how it is. And I can't state that any further enough, but just wait and manage the risk. Don't be fully leveraged and everything like that, but you already know this, so I'm not going to bring another same set of charts to say this same old thing once all over again. So buying holders of cryptos, god damn it, don't even fight that. Don't even be afraid. I mean, just taking a daily chart in here, this is exactly what your chart should look like. If you are a buy and holder, you shouldn't even give a fuck about anything that happens in that black box. And if you actually want to do some short-term trades, like I do, I mean, just be rational in here. What you have is not bearish, it's not bullish either. It's just worst case scenario is a range, best case scenario higher lows and higher highs. So just wait for this to play its game. You'll just let the bears do anything they can, and whenever they'll be exhausted, we'll be back in the games to buy this market. To me, it's pure and simply this. No more complications, anything like that. We're just in a bullish cycle right now, and I see absolutely no fucking reason to change that. The cycle remains bullish. This is just because that's the last candle calculation, but we're there, all right? So this is where we are. We're as bullish as we could be. We're still trading on top of previous support areas. Why the hell would you be bearish? I'm not even thinking about bearish right now. It's just this is bull's time. Just let them do. We can retrace in a bullish cycle as long as we don't break the previous low. So as long as we don't get there to $102, that's not even something to talk about. Okay, let's be honest. Talking about the bear side, it's not the bear's time to trade. So if they do trade in here and do break support, means we have a problem, and there we'll have something to talk about. Until then, it's just for dumps to talk. I'm sorry to say that, but this is basically what I'm going to tell you guys each and every day, as long as we have something viable to say. As long as we don't break that resistance again, or don't break that support, it's just a bullish cycle that's having a retracement. So just let it go with the retracement. Worst case scenario, it's a range, or worst case scenario, it's a bearish trend, and therefore will be stopped out, and that's the game. All right? There's always a risk for you to be wrong. I still don't think this risk worth any action right now, so just do nothing but waiting. All right? So instead of just bringing the same old fucking SPX charts, what I'm going to do today instead is just talking to you about something more interesting, which is the repo market. So let's get it started. All right, so let's talk about that repo market right now, and we're gonna just do it. I'll try to do it as simple as it can, but it's a really complex thing. But I'm just gonna try making you understand what the processes are, why this thing is so broadly used today, and why this thing is the heart of the problem, because this is where the money is circulating through, and if it just stops, then the entire system freezes. So let me explain that. We've got three major actors. So we've got the banking sector, which is in here. We've got the corporate sector, and calling the central banking system, which is in here. There are the three major elements of that system that ripple money through all those three. So we've got a fourth one, which is basically government, and we're going to say that all over again. So we've got banking system, so financing banking, all right, investment banking. We're not talking about retail banking in here, not at all right? So this is, as we said, central bank. All right, these are the central banks. This is governments. all right? And here you've got corporates. All right, so this is how this thing works. The economy is money circulating in here, okay? So, and of course you've got people in here, but we're just going to avoid people to make it simpler, as you don't even have a role in that big game. So the way it plays out is that the banking sector is lending money to the corporates so they can create goods and make profits out of here by selling those goods, and with those profits they're going to return money by interest rates. They're going to return the lended money plus interest rates. So, all right, corporates are lending. No, sorry, they're getting debts. All right, they're contracting debts to pay for goods, to pay for machinery or anything like that that will help producing goods and make profits. Okay. So they are indebting themselves to get profits. So if you're thinking debt is bad, no, debt isn't bad. Debt is just here to pay for future profits. Okay, but the system works just fine when the profits are here to pay for the debt. All right, so what we have in here, the banks are lending. And capitalizing. All right, these are the roles, each and every one of them. So in here we've got lending money. All right, so they are lending. So we call that a. All right, they're emitting bonds. Okay, so this is where the bond market plays, the corporate bond. Okay, and obviously in here, this is where you've got the rates. Oula, sorry. Or interest. Okay, so banks are lending money to create corporate debt through bonds, to create profits that will bring interests and help capitalizing the banks. Okay, that's how those two guys are working together. Obviously, profits doesn't just come in the form of interest. Lots of them comes to fees and fiscal policies, so taxes. All right, so we're going to do taxes. Okay, part of the profits comes back to government through taxes. All right, and then governments are not meant to be capitalizing. Government are not there to make money, they're just here to redistribute. Okay, redistribution. Okay, that's the government's only role, redistribute the money, and they're just helping to redistribute by sending more money here and there or here and there, and you'll see they'll have help throughout the entire system. So the profits are bringing taxes that helps the government to redistribute those taxes either to the consumers, most likely consumers generally, but we haven't used this. Okay, so we haven't, but there's a fifth bubble definitely in here. Okay, but they're not just redistributing, they're also creating, so there is also debt that's been creating by the government. All right, so taxes are the tax-through profits are here for the redistribution. Okay, they are helping the redistribution branch of the governments, but they're also bringing debt. This is where comes the central banking system that will show up later. Okay, so now debt is the government debt isn't contracted by banks. The corporate debt comes from central banking sector only. Okay, but the central banker is obviously working out with redistribution. Okay, because they give debt to the government, but the government has to follow some rules, otherwise it doesn't work out. It's not just getting money to do whatever shit you want. It's just you're going to have to follow some rules, and central banking system is also having its own rules. All right, but so this is the central banking role. All right, throughout central banking and government things. Okay, so it's government bonds, all right? So I'm going to call that CPT for corporate, or CRP. All right, so corporate bonds and government bonds. Okay, corporate bonds are lended by banking system. Government bonds are lended by central banking system. And the beauty of that system for the repo market, you're gonna come out of those two, and you're gonna understand the pretty dangerous link that we've been creating in here, and the fact that we're gonna have to pay for the side effects sooner or later. Reason why the repo market has to be looked at pretty significantly. So anyway, the banking sector has a role throughout central bankings, obviously. This is where the nasty part comes, or just starting. So the role of central banking is price stability. So that's the beauty, all right? So that's what you have in your beautiful economic manuals. So price stability is the only role of central banking. It is definitely no longer what this is about. Because what they're doing is lending, it's what we call monetary creation, okay, so monetary creation, but definitely that's just lending money. That's because monetary creation, most of the money creation is done by bank. You're thinking that the central banking system is the only one who can create bills. It's pretty far from the reality. The reality is most likely banks who are creating money nowadays, private banks. Okay, but they're doing it as they are allowed to by the central banking. So we'll see about that. So monetary creation, let's call that just lending, all right? It's just lending as well. So they are lending money, but only to government. They cannot lend money directly to corporates. But they start doing it. I mean, it's just, back then, we're going to start with that, okay? So this is what they were doing. To ensure price stability, they were lending money to corporate debt, government bonds, and they were basically playing with the fifth bubble, that is the retails, the consumers, like we do, and they were just ensuring price stability by playing on interest rates. Okay, so they are just defining interest rates. This is where this is the tool they are playing with. All right, to ensure price stability. Interest rates is the tool you use to bring price stability. Lending money is definitely government bonds, all right, debt. And as we said, the redistribution also comes up. Let me just do it better in terms of organization. Let me just do it a little bit more easier for you to get to. So debt, all right, and taxes are here to pay for debt as well, all right? Okay, so there you've got your government bonds. Here's the taxing system. All right, so government bonds, and obviously the government will redistribute the income taxes as pay for lending money through interest rates as well. Okay, and so the price stability is managing those interest rates. Okay. So this is mostly what the price stability is driving out to. The corporate, the government interest rates, okay, and also the God damn it, I'm searching for the word. Okay, no worries. I'm going to just let you go with that. It's not that important. All right. So this is how it goes. And then you've got additional roles. This was the initial roles of central banking, and now they just created a pretty fucking nasty roads, because what we're doing in here is a system that we're working pretty fine, but then 2008 just show up, and we had huge problems in that beautiful system, so we had to create patches. And the way we've been creating patches is that central bankers just took over the entire market some way. They done that pretty smartly, because it wasn't intended to be that way back then. When it just been created, it was just a good solution that just went out of control during this economic cycle. And the repo market is definitely the worst case scenario, because back then we had central banking lending money to governments, banking sector creating money for the corporations, and we had and we had absolutely no link between central banks and corporations. We had no direct link, which means the market, the stock market, is in here. Okay, this is where your stock market is. You're pricing the corporate benefits. Okay, this is, oh shit, what this is? What is that? All right. Just cycles on. So this is where the stock market is. And back then you had all those elements aside from the stock market. Okay? The banks could be part of the stock market as well. We can consider this to be a stock market element included, but most likely it's just corporate profits that counts into S&P 500. All right? So this is the way that this was working before. Money circulating from the stock market, coming from the banks that were just led by central banking, because obviously, who's financing the banking sector? The corporates' profits. They do financing the banking sector, but since 2008, we created this beauty, which is the central banking can provide money to banking sector through direct channel. They weren't about to do this before, now they do. Since 2008, it's pretty great. Central banking can create any amounts of money available for the banking sector to capitalize, which means when interest rates coming from corporates are not sufficient enough to capitalize the bank, then they require the central bank to play its nasty game of capitalizing, of bringing capital to banks. And they're also the beauty of government to capitalize bank, because that's what's been happening in 2008. So when the banking sector has problems, what you can see is that the beautiful system we had is having interconnections right now, more interconnections. So this is what happens when you've got crisis. On crisis, governments just now pay to capitalize the bank in order to keep on having the corporate profits to run so they can have taxes. But instead of redistributing directly to corporations, they're doing it through banking system. So when we're in the perfect banking systems in which bankers are here to just redistribute the money and not just making shit tons of profit out of here, then this will be working just fine. The problem is we do have nasty bankers on top of really great bankers that do a pretty great job, and we need bankers, we really need them. The thing is that, yes, obviously some guys are pretty narrow-minded and selfish and just want to make their own profits out of someone else's back. So the problem is we're interconnecting, but we didn't stop that. I mean, we added central banks to capitalize the bank on a direct channel. Back then they were unable to do so. They had funds in which banks could take the money if necessary. Now they're just directly lending to banking. So the way they do this is using that beautiful repo market. Okay, so this is how it goes. To capitalize the banks, okay, the central banker is now lending money to corporates. Okay, but this lended money, it doesn't come. Lending money means creating money. Okay, so this is where we're printing the money by creating new loans. A new loan creates money. Paying for that loan, refunding the loan, just basically destroys money. And you have to really understand that, okay? So this is the way the shadows works, okay? So the tax plan, lending governments so they could create debt, redistribution to central banks, and recapitalization. And then they're lending money to capitalize the bank, who are paying interest rates in return as well. Obviously, lending always comes from interest rates. So this is how the beauty shows up. All right. So how do you call that? This corporate bonds, government bonds. What is that? How do you call that? Banking bonds? No, we're gonna call. Yes, this is banking bonds basically. But what we're gonna say that is that this is. Yes, we're gonna call that. Okay, banks are corporates. So basically these are like corporate bonds, but we're going to call them banking bonds because they're using a separate channel, which is the great danger, because normally central banks shouldn't be dealing with banks, and if they do, they should be dealing like any other corporate, because now banking's system is acting like a corporate. And the thing is that they don't. Now we've got a special area in here. So this is the stock market, okay? And this is the repo market. And this is where the obviously beauty is happening. So in the repo market, what repo does mean is pure and simply repossession. And we're going to explain what this is. So let's call that repo market, okay? Call that simple, and most people just call it that way, so let's do it as well. So this is the repo market, the beauty of it, and the thing that you absolutely need to understand in here. What's the role in here is creating a perfect money circulation thing, but the thing it's also doing is just rising the central bank it's adding another layer of dependency to central banking, because now central banking are just lending all the money to the banks throughout this repo market. But the thing is that corporate bonds, they come with an interest rates, an average interest rate for corporates, and I'm talking about graded, high-grade interest rates, is generally, let's call that high grade. They generally have approximately 4.5% yieldings, okay, and obviously junks, which is the lowest company, junks grade, they generally have 7 to 12, or it gets even worse than that on some cases. Junks grade, okay? Government bonds are considered to be almost AAA most of the time, so AAA just basically, or it depends, but the thing is that government bonds do have what we call QE and things like that to just help. So let's say normal yielding is approximately 3%. All right? Accommodative, or let's say normal, 3% is absolutely, it's kind of normal. What should be normal in a normal world, but we're no longer close to this. Accommodative is 1%, okay, and let's call that unicorn is 0% or negative, okay? It means we have negative yields. You can lend money and not even pay for that in return. That's great. It's great as it's ever been, okay? So the central bankings are fixing, it's not interest rates fixed by the central banking. It's not direct because you're not financed from the central banking. Some people would just say, call me a liar. It is not that easy, but it's basically the government bonds yieldings are mostly priced in by the central banking, but it's not refunded to the central bankers, okay? Damn it. All right, that's how it is. We should have been doing it the opposite way. All right, let's bring the interest rate in here, so it's going to be easier for us to understand. No, it isn't. So, okay, fuck that. All right, we'll stick to this. Okay, so anyway, what you have to understand is that government bonds and corporate bonds have a pretty different yieldings, because by definition a corporate can do default. So so they have higher level of risk to default, and therefore they're going to have a higher yielding for their bonds. The thing is that government cannot, by definition, do default. All they can do is require inflation of their currencies, which is pretty significantly close to, but not the same. So in terms of risk management, less risks in government bonds, therefore they have an average lower pricing, yielding, interest rates requirements. But the beauty is that the banking sector, this should be acting like a corporate bonds, and I have a special market just for them to lend money at fewer and lower rates. The thing is that great, because this is where the biggest amounts of money are circulating right now, because we need to have those banks capitalized enough in order to make sure to maintain those levels of interest rates as the risk is rising. Because right now, we shouldn't have having such rates. We should have higher rates because we're risking to head to recession, and recession means lots of corporates will just die. And they will not pay for 10-year yieldings they've been asking for the corporate bonds to be. So some of the loans that have been done probably won't be funded. So there's a problem in the money circulation in the years to come. So how do we sustain the system to survive, as we know problems are ahead, but we just don't want to deal with them right now? So in order to lower artificially the corporate bonds, which means there is a high level of risk for those interests to don't go capitalizing the banks 5 years from now, because probably a recession will show up in between. So how can the banks keep on lending for these rates as the risk is rising? They have to put that risk to someone else, and guess who that third party is going to be? The governments, because if they do fail, we do know that redistribution is definitely going to play recapitalizing the banks, but as it is not enough because the money in circulation right now cannot be funded by governments, it's not going to be enough. It was enough in 2008. We have 4 times the liquidity circulating right now, which means no government in Earth will be able to capitalize the bank anymore. So what did we do? Instead of fixing the problem, we just patched it like we already do. We created an alternative market that was already existing, but we just took entire advantage of it to just make this old system survive. I'm not saying that we won't find other solutions like that in the future. All I can tell is that this solution of the repo market has been overplayed for 6 to 7 years right now, and we're pretty much reaching the point this niche will collapse. Because this is definitely a niche. And let's explain how it goes. First, a few guys are getting in the niche and profiting from this, and then everybody gets in because there is profit to make in here. And the repo market has been bringing crazy shit amount of profits. But it also been creating very deep links between banks and central banks that should never have took place. So how this market works, let's get to dig into the essential things. As we said, the core problem is that banking system as corporates should have corporate bonds themselves, and they could lend money, but normally with the level of risk according to. The thing is that the repo market doesn't work like that. The repo market brings the central bankers and the government bond, because the repo market difference between corporate bonds and government bonds is that the repo market asks for a collateral, okay? Which means the difference is that a repo bond, okay, call that there, okay, a repo lending. Now, repo bonds are not tradable, or they could be tradable, but the thing is that they're short-term bonds, basically lending one day to another or 1 week to another, so they're pretty much never traded. They could be, but they're not. So the thing is that it's more like a perception of trust. As long as the two parties are trusting each other, the central bank and the banking system, everything works just fine, because the collateral must be a very low risk asset, and it's almost always government bond. All right? But the beauty of it, as we basically taken all the government bonds available to make this collateral system work, and the enormous amount of money that's been circulating in there is not sufficiently enough fueled by the government bond, which is an enormous, absolutely enormous market. So an enormous market is not sustainable enough to play for this game, to keep on playing this game. So the collaterals have started to be corporate bonds, which is pretty fucking dangerous, because as we said, corporates will be the first one to suffer if a recession is down the road. They'll be the first one to pay for it. So instead of using long-term visions, because that was the goal, the repo market is working by just a simple way. In order to downward pressure the yieldings, so instead of paying 4.5 to lend money to capitalize the bank, they will capitalize directly to central banks on a day-to-day basis to pay for speculative activities, but they'll do it with 1.5, 2% yieldings instead of 4.5, 6, 7 yieldings because of high speculative activities. So we know the risk is rising, but the repo market is pretty low rising. They're lending money with pretty low amount of debt, which is crazy dangerous, because there is a risk, but the risk isn't priced in, because we do use this beauty of collateral damage. What we do is that repo market works like that. The lender the lender, the one that's going to give the money to the lender, the lender is going to ask money for the central bank, and the central bank will say, okay, if you want to have this rate, then you have to bring me a government bond. So what happens? The banks that do have lots of these government bonds are going to just collateralize them. The government bonds stays into the banking capital, all right? So it stays in there, but it's just collateralized for the central bank to sell it in case of default. So if the bank goes default, then the collateral, which is government bonds, will be sold to the market to pay for the loan, all right? Which means as long as everything goes right and the collateral has to be used, then the system is just fine and it's just reducing the debt costs, which means you can lend money at pretty lower cost as long as everything goes great. When things start to not do great is where these problems will start to show up, because as long as we were doing government bonds, no problems. For a simple reason, government cannot do default. They can't, all right? So government bond will always worth something. They can be less valuable, but they will still value something. A corporate bond just worth absolutely shit if the corporate goes to default. And this is an instantaneous thing, which means when the corporate makes default, it's a switch. It was viable to pay for the loan, and the day after it isn't anymore, and it's not going to pay anything. So the problem is, as now we're accepting corporate bonds and other shitty bonds as a collateral, we're obviously not accepting junk bonds. We're just accepting high grades as a corporate bond. But the depth of the government bond system is freaking crazy higher than the corporate bonds, because just most of the corporates are junks. Some corporates are high grade, but just many of them are just one step to switch to junk bonds nowadays. Just to be giving you a number, half of the high grades right now, just half of them are just one step away to be switching junk bonds, which means they won't be available to collateralize in the repo market. And the repo market will just die out of liquidity. That's how every niche is dying. As we still have profits to make, everything works just fine, the day we'll have no longer market depth as a collateral, then this thing will no longer work. And if this doesn't work, and if banking sector has to lend money at the same rate as a normal corporation, then the whole entire system just blows up. Because they will not be able to lend money to corporation. They will have to pay for the risk of those corporations to eventually make default. So this will definitely be not this kind of average yielding, but much higher than that, which is going to narrow the profits, which is going to narrow the taxation, which is going to narrow the government accessibility, which is going to narrow the central banking system possibilities. And the only thing in here that can create money all by itself is the central banking system. So nowadays, if we do live in the central banking area, it's definitely because of the repo market. Because the repo market has been creating crazy dangerous spider web in the entire economic system that just relates on this simple word. Okay? Collateralizing the damage. Which means nowadays, if we do have a problem, it's gonna burst everywhere. Because we've been collateralizing the risk. We've been creating tiny links between each and every actor of the economy itself, which means if someone goes wrong, everybody will have to pay for it. That's the beauty of it, because no one is going to be hidden nowhere. So we pretty damn hope everything is going to be great, everything is going to work fine. The problem is we have early signs that this beautiful mechanic is starting to dip, to kind of finding a roof limit. Because as I said, the depth of those markets, I mean, it's like nowadays all the government bonds are pretty much all the acceptable government bonds. We're not accepting all the bonds just as well, only high grade in here. So what are the bonds we're using? US bonds, German bonds, French bonds, Italian bonds, still so, but they're not really well seen nowadays. So if you want to get repo market with an Italian bond, it's acceptable some way, but you're definitely not going to get the best rates. You're mostly going to have a much better rates if you're bringing me a 10-year yields of Germany. So guess who's buying the German bonds, and for what reason? They're buying it because it helps bringing down rates on the repo market. So even if that doesn't even give a shit about coupons, it brings you repo market down. So you got better rates on a day-to-day basis. So guess who's interested in the Eurobonds? The banking system. But is it for an actual true manner of government bond pricing? No, it's just because it feeds the collateralized damage of repo market, which is pretty fucking dangerous, because the day this thing works just shit, you can be damn sure the Eurobonds will just fall like hell, because no one will ever need them. We'll have a German economy, recessive economy, with the bond, whose bonds will no longer be acceptable in collateral damage. And if they don't, I mean, who's going to need it? Who's going to accept to pay for this? No one, which means prices will probably surge to the downside. So the problem is this. I'm not wanting to scare you out, just want you to understand that nowadays we're still having the same problems as we did back in 2008. The thing is that instead of solving those problems, we've been patching it with even more blood. And we're doing anything we can to just prevent this thing from shitting bloods everywhere. But it's basically what may happen someday if we just find another way to create an even more complex system, which I don't think we can in the current stages, even though human is pretty inventive, and I cannot stand to believe that at some point I still don't know what interconnections we may create in here, but I still tend to believe we could find something in the future, but so far we don't. So far we're working with that system, which is pretty much exhausting itself. The repo market average bond has been doubling in the during the last 12 months. So in a year from now, repo market was pricing 1.5%, 1.6, we're now at 2.5, and just 2 years ahead we were pricing 0.5. So in 2 years, the repo market, which is most likely a day-to-day or week-to-week lending money, so short-term money that just helps the bank to be capitalized enough to create and make this system functional. But the thing is that those intraday rates have been pretty significantly rising as the risk is rising, definitely is because of this, which means risk is rising and prices are rising. Somehow things cannot work out this way forever. We have a problem. Either it's going to be bond problem or repo problem, or we're going to have a corporate problem some way. But we cannot price for the best and having yields rising. It doesn't work out this way. It means somebody's lying, and I still tend to say normally bonds are not lying. Corporate can lie. Corporate prices can be led by speculation in the short run. These can last a few months, a few quarters at best, but no more than that. Interest rates and bond market is pricing in the risk, and it never lies. It can trick things, make things trickier by just hiding the risk somewhere else. This is what we've done. The risks were rising, but we maintained low level of depth pricing because in order to pay for that risk, the banking sector has just been putting that risk away into central banking system. So nowadays, central banks are holding the risks until they don't. It's simple as that. It means it's just like back then, banking were holding the problems. They were too big to fail, and obviously no big investment bank could have been defaulting back then. And then 2008 happened. So, is a central bank going to be defaulting some way? I think yes. I think it's going to happen. Because that's how the world works. Anything that is too big to fail always fails. And central bankings are no more than big banks. And thinking that they can't default is a big mistake. Because they do. They can't fail. It's just they have to create money. They need to lend money to the banking system. And you have to understand that if you're thinking central banking are creating money out of nothing and just printing bills, they don't. That's not how it works. We're creating money by lending money to other financial actors. And the central banking is creating money by lending this money to the banking sector. So if the banking sector just loses confidence in central bankings, then the system dies. Because it's simple as that. This central bank as you think is too big to fail, will just be unable to create money because they don't have the right to do so. If the banking sector don't ask for the money, they can't create it. They cannot create money to finance corporation directly. They can create money to facilitate corporate bonds ability, but that's all they can do. This is TLTROs. Okay? Central banks can help with TLTROs, help creating and favoring bond market in the corporate sector, but they can definitely not finance corporate directly. At least not in the current days. Maybe tomorrow this will be the answer to this. Central bankers will be able to buy everything. They'll be able to buy corporate bonds. They'll be able to buy government bonds, to buy everything. And the central bank will just be this big guy who is pricing the market until too big to fail. So simple as that. So be aware that the repo market is definitely the big underlying danger today. It's not necessarily that it's going to go bad. All I can tell is that there is high level of systematic risk in this bond market, in this specific repo bond market. And it's rising concern recently. So all I can tell is that just watch out for this. Not saying that this is where the black swan will show up, but all I can tell is what could be a black swan today. I mean, so many things are possible. Just a big corporation unexpectedly failing, a big bank failing, just like in 2008, big bank showing up big deficits and just not enough to pay for its losses, and it's just going to have to sell all its assets, creating a crazy panic selling in the entire stock market. Or it's just a central banking going absolutely off the roads. And if such thing happens, and if banks just lose confidence in that central bank, then I bet and I hope we got to create some new tools to avoid the carnage, because if central bankers just loses confidence by the banking sector, then that's the end of the game. Money will stop circulating, and you know how it goes, financial crisis and same old stuff. Money doesn't go from government to corporates. The money isn't circulating normally, and when it does, it's definitely a recession along the way. So God knows what's going to create the next recession. All I can tell is that risks have been piling up recently. Some sectors are pricing in that risk. All the bond markets do price that risk, but there are some collateral damage and collateral distortions included by that collateral system, which makes the government bonds pretty underpriced regarding the current risk. I mean, at that stage of the economic cycle, we should be pricing 4.5 interest rates on the US economy, and the euro area should be closer than 2.5, not to say 4.5 as well. So the repo market is fucking up the entire bond pricing right now, but this is just a distortion. We've been putting a risk into areas more complex for the public not to see. So the risk is there, it's definitely there, it's just that we've been putting in some very dark corner, and just for this to wait until it shows up to light. And I think the days in which that risk may show up back to light is just coming over. We know it's going to come over someday, we just don't know when, and we're starting to see this dark corner showing fewer square meters to hide. So at some point the beast can still hide itself, and hopefully we will be able to kill that beast if it ever shows up. I mean, I don't know what tools the central bankers could be showing us in the future, but we definitely need something new pretty shortly if things get out of control. And I hope we will, because if things get out of control, central bankers will be the only one to save us, and I kind of don't like that, because anytime we've been thinking like that, it's always when the financial crisis showed up. Back then, we were just hoping that the banking system will just hold on. The risks were increasing. We knew that the default risk was rising as well on the housing sector. We knew that default was just rising to crazy level. We had 8% of loans, of housing loans that were just not paid. So it was enormous. 7% of people were making default on very low yielding. So there was a problem. There was risks out there that that just weren't priced in. And obviously it ended up with the housing crisis in the US. And nowadays we have the exact same problem with the corporate financing. corporate financing cannot be that low at this stage of the economic cycle, because the risk now is for those corporates to just lower their profits in the future, because the economy might be just contracting, and if they do, then they shouldn't be paying for 4% yielding in that perspective, because that's not what the economy should do. So risk is there, it's just not where you can see it. It's just in that hidden sector in which day-to-day money is circulating pretty fucking fast to make this system work, but it's like a short-term reaction to a huge problem that we've never ever solved. It's the 2008 problem, the problem of debt badly circulating in the system and accumulating into bubbles. That's the same old problem that's been creating the 2000 bubble as well, and every bubble. When credit accumulates, it creates bubble, and those bubble bursts, and as those bubbles tend to inflate, they will inflate the risk as well. We're going to try hiding those risks. In 2008, what was the solution? We just created CDOs, we just created all those things, credit default swaps, we've been creating nasty packages of debt, we've been doing anything we could to just hide the problem until it bursted to our faces. That's exactly the same stuff we're doing right now. We do know the problem is here, we do know the risk is rising. What do? We hide it as much as we can until we won't be able to. So be aware of this. This is where the risk is. It's hidden. So if you think there is no risk because the VIX is down and because the bond sector just performs pretty well, then now you know why it's working fine and why it is just an illusion. And just to conclude in here, I'm not doing this to scare you out. I'm not doing here to tell you that there's obviously the end of the world coming along the corner. I stated this pretty clearly. All I said, and I stand for what I said, is that we're definitely going to have a problem by the way the system works nowadays. Regarding the increasing risk, it's not going to work forever. It's definitely going to be crisping the problems at some point. The only question is, what will be the answer? If we do find new economic tools to patch up this one more time, and if we manage to avoid a financial crisis in between, which I doubt, but could be understandable. I mean, all I can tell is that, yes, we're definitely relying on central banking system right now. And the question is, how will they be able to handle this? If shit comes up, if they handle this pretty quickly with massive tools, and if the people accept those massive tools, then great, I would say we can avoid a financial crisis. But in the current stage, I think we just can't avoid a financial crisis. I mean, it's just going to show up someday, for some God knows what reason, but I still tend to believe, yes, it's going to show up. So you must not be pricing in a recession and a financial crisis, but I mean you should just brace yourself, making sure that you're not stupidly running in front of in a car that is driving at 260 kilometers per hour. It's exactly what we're having right now. The car is running as fast as we could. We're just taking the highest level of the highest amount of risk, and no one is even bracing himself for the potential accident. That's exactly what you think, what most people think. But I mean, the only rational decision right now is just to be out of this car or to brace your fucking selves, because something ugly could happen, not necessarily going to happen, but you shouldn't even be in that car. So buying right now is not an option. And I stand for this. That's the only rational decision to do right now. Just watch out the stupid guys who want to jump in that car, because it makes a lot of noise, it attracts a lot of interests, and you may think that you have to be among the party and that this is where the party goes. But if you just see those guys doing stupid decisions, just let them do. I mean, I'll be there to pick up the car at some point. That's how it is. I mean, I don't give a shit about people having fun with the stock market right now. It's not about having fun. It's about taking decent amount of risk for a profit. And I think right now, bullish profits are taking crazy fucking amount of risks to get there. And I won't be surprised if something ugly happens. That's all I can tell. All right. So don't misunderstand my purpose in here. It really isn't to scare you out, just assessing you what the actual risk level is, and therefore how you should position yourself ahead of that risk, which means don't go all in for stocks. It's definitely the worst choice ever. Don't go all in on selling the stocks neither, because that car could pretty well keep on going for a long time before crashing. And if it does, then you're just going to lose money, which is not the case. case. We're not here to lose money. We're here to make money. As I said, right now, selling is the only option, but do it really cautiously. Make sure you're not selling for the end of the world. It's the worst case scenario. Make sure you're not selling to bring down the system, because that's not a good choice as well. If you think this is stupid behavior, that the banking system should never work out that way, so do I, but I don't trade that. I don't trade this way. You're not trading to bring some rationality back in the market. If you do that, worst trader ever. Not going to do this. We do that because we've got nothing else to do, but we know the level of risk is also very high in terms of selling. Therefore, you shouldn't be selling with that much amount of money. All right. I'm sorry to say that all over again, but I thought doing this today was more interesting than just doing another analysis, saying the good, same old stuff, but rather instead talking about the repo market. Bye, guys.